So I'm Mike Graziano, as mentioned. I co-head the global real estate investment banking business at Goldman Sachs. I've been focused on this space for about, over 30 years, which tells you I'm either very stubbornly dedicated or completely unemployable elsewhere. But it's been a long ride. When we first started in this industry, most of the companies were private. The securitization of real estate hadn't yet begun. And you flash forward to where we are today, and we've had a number of tops and turns throughout. We have a great panel today. I want to first start by thanking Robin and Adam for putting me on the first panel this year. Historically, I've also had to deal with the last panel, where I've been up here making animal balloons and shooting T-shirts into the audience to keep everybody awake. But everybody's bright-eyed and bushy-tailed as we get going here, which is great. So I thought the easiest thing, the best place to start, particularly for the students in the room, is to have each of you just walk through, tell them who you are and what your company does. Not the investor presentation, but just the 20 seconds, and then we'll get into it, so everybody knows who's who.
All right. Good morning. I'm Mark Perrell. I'm the CEO of Equity Residential. We're a housing company. We own 80,000 apartments throughout the U.S., mostly think about like big coastal urban centers is where the strategy focuses. So Boston, D.C., New York metros, Bay Area, Southern Cal, and Seattle. And then that Sunbelt argument that was just discussed is something we embraced some time ago. So we now have about 5% of our NOI in Texas, Austin, and Dallas, as well as in Denver and Atlanta. So we have a pretty active sustainability program as well, a lot of things going on there in the residential space. With that, I guess I'll pass it along to Ed.
I'm Ed Petoniak, the CEO of VICI Properties. VICI Properties is an experiential real estate investment trust. And what we mean by that is that we own real estate in which the consumer acquires an experience, and that experience takes place within the real estate. At this point, we are principally invested in gaming real estate. As an example, we own about half of the Las Vegas Strip, 10 assets in all, including assets like the Venetian, Caesars Palace, Las Vegas, MGM Grand, and Mandalay Bay. We've also begun to diversify into other areas where there are great placemakers and operators creating great experiences, such as Cabot in the golf space and Canyon Ranch in wellness.
Good morning, Connor Flynn, CEO of Kimco Realty. We are the founder of the modern REIT era at Kimco, so first to go public in 1991. We primarily own grocery-anchored shopping centers and mixed-use assets. Our strategy is to focus on the first-ring suburb of really the top 20 major metropolitan markets and asset manage and redevelop those assets.
Hi, I'm Owen Thomas. I'm the chair and CEO of BXP, and we're the largest public company that focuses on premier workplaces, formerly known as office buildings. And we're focused on large coastal cities, so we're a big company, but we're focused really on 6 cities: Boston, New York, Washington, D.C., Seattle, San Francisco, and L.A. I think importantly as well, our primary growth comes through new development. And we also have some adjacencies to our office business, which is in the life science area and in housing.
It was okay with you, Owen. I thought we'd spend 45 minutes on return to office this morning.
Yeah.
Is that okay? So we all know each other very well, and we were talking about what we want to discuss, what would be the best thing to discuss at the panel. I promised them we were not going to just keep going down the line. We're going to do it one more time because I think it's important to set the macro stage, and then we're going to mix it up with some questions. But there's the saying, I'm not sure anybody knows exactly where it came from, may you live in interesting times. At least we have that going for us for the last couple of years. I think we all wish it was less interesting than it's been. But just to set the macro stage, I would say over the last 18 months, all the dialogue we've had, everybody seems to be an armchair economist. It's been said that everybody has a view, but nobody has a clue, because I don't think anybody has a crystal ball. But with that caveat that no one expects everybody to have the answers, maybe just go down and just give your 1-minute view of where we are macro, like where are we going, right? There's some people that are more optimistic, some are more pessimistic, but your individual views as to where we may be headed here over the next year or so.
Boy, I don't have any idea where we're going, but I will say this. Equity Residential as a housing provider is in a really good position because we rent homes for people. It's a basic need, and single family is quite expensive. So those markets I listed for you, the big common characteristic they have is increasingly expensive owned housing, and owned housing is our major competitor. What's going on with the regional banks and what's gone on with cost of capital means there'll be limits on supply on new apartments built. That's really important to us. And the third piece of the picture, which is the part that matters really the most, is the demand part, which is all about jobs for us and growth of income. Our residents generally are pretty affluent, so our household income is about $172,000 a year, and they pay us about 20% of their income in rent. These are folks that are in industries like tech, but by and large, we have not seen people give us their keys. We continue to be very well occupied. The business continues to be one that's got a great deal of demand. So I really like our setup as it relates to supply. I like the setup as it relates to demand, and I think there's going to be a little volatility. I certainly feel like jobs are tailing off, but again, with the kind of shortage our country has of housing, there is between 3 and 6 million less housing units than there should be in our country, and particularly in the places we are. I think that's going to really support us through the cycle, even if we cycle down a bit over the next couple of years.
So I grew up mainly playing flow sports, soccer, hockey, and lacrosse. And one of the fundamental aspects of those sports is you got to be able to transition from offense to defense and back in split seconds, right? And I was never actually that good. I was small, but I was slow. But what I recognized in the great players was that ability to anticipate and make that transition either from offense to defense or defense to offense as quickly as you could. And certainly the last couple of years has been a challenging period because of COVID and now because of the state of the equity and the credit markets to know exactly where the puck is going. And yet you want to be ready for whatever is happening. In 2021, we weren't sure if it was the beginning of a new cycle or the end of an old one, but we decided it was a great time to get aggressive. And I'm looking over here at Todd Lenson and Jordan Rosenbaum, Kramer Levin, when we did 21 billion of transactions in 2021. We even have the T-shirt to prove it. But right now, it's really hard to tell. And because it is so opaque right now, because the lack of confidence in pricing and value is so low, it's a great time to take time and formulate new insights. And especially for the students in the room, great real estate is a consequence of powerful insights. And you're really privileged to hear very soon here from Ron Havner, because think about what public storage represents as insight before you think of public storage as real estate. Because public storage came off of an insight that, wow, Americans have a lot of stuff and they move a lot. What might that mean for real estate? And Ron's going to tell you about that much better than I ever could. But it's about taking the time to think about how people are living, working, playing. And Adam, I think, put it very well in his opening remarks. If you know where the culture is going, you can make better investment decisions in real estate. And we actually have the time to do that. And again, when you're young, you actually tend to be closer and more integrated into the culture than super old guys like myself. And take advantage of that. I'll just finish up by saying, back in the 80s and 90s, MTV was an amazingly powerful medium. And one of the things that made it so powerful is that the CEO at that time, Judy McGrath, built the company around interns because of her conviction that interns were much closer to the culture than anybody who had a full-time job at MTV. So take advantage of being young because of your closeness to the culture.
So at Kimco, I think we're all in the same boat trying to figure out where the cracks are in the economy. And when you look at supply and demand in retail, for a long period of time, retail was oversupplied and we had to go through a cleansing period of really a tenancy as well as a location upgrade. And what we see today is really interesting is, where our strategy is focused on the first ring suburb in the top major metro markets, the supply and demand is very much in the landlord favor, which might be surprising to some because we're actually near peak occupancy and we have more demand and virtually no new development. So that's a good setup in terms of, the next few years because in my opinion, there really isn't a lot of new supply anywhere near on the horizon. So the interesting part of our business is we're sort of the fulcrum point of the consumer, the retailer, and the landlord. And so in retail, you have to be a five-tool player in a lot of ways, where you have to be good at a little bit of everything. And what we see today is that the essential goods and services that we're providing, typically it's a grocer and then services around it, have snapped back dramatically, and in some cases the traffic patterns are above pre-pandemic levels. And you ask yourself why? Well, what's changed? What's happening there? And a lot of people's daily lives have changed because of COVID, and their trip routine has changed and become more frequent to the shopping center. It could be for a number of reasons. Hybrid work model, obviously, that's here today. People shopping and living and working closer to where they live is important to some folks. Value and convenience, I still think, wins the day. And that's what we strive to provide. That being said, it is a very good time to collect your nuts for winter, because I do believe there's going to be some level of distress coming and some level of opportunity coming. And typically generational opportunities present themselves when others are fearful and don't have access to capital. You can't have bank failures, in my opinion, and not have any repercussions. We haven't seen any repercussions yet in our business. But that being said, you should be prepared with low leverage, access to capital, ability to act at times like this, because typically that's when you can make a lot of money for your shareholders.
Well, I'll start with the caveat that the future is hard to predict, but I'll share a few thoughts with you. I think this whole debate about, are we going to have a recession, hard landing, soft landing, I would bifurcate the economy between businesses and the consumer. And businesses are, depending on how you want to define a recession, in my opinion, are already in a recession. Corporate earnings this quarter are predicted to be down 6%. Some analysts think more. And that has impact on our business because our customers are not individuals, they're corporations. And many of them are laying off employees, taking less space, and that has a direct impact on the office business. So what's driving GDP? It's the consumer. The consumption is 70% of GDP. And if you look at savings rates in the country, Americans, or people all over the world, saved a lot of money during COVID. They were at home. They weren't doing anything. That savings rate was incredibly high then. Now it's below average. So everyone is out traveling, buying stuff, making up for lost time in COVID. And I think the key question on the economy is, when does all that money run out? Because when it does, that's when you'll answer this question about whether we're going to have a recession or not. So I agree with what's been said. I think we have some choppy roads ahead. By the way, if we do have a recession, one positive aspect of that for real estate that will mitigate interest rates. And also, I think we all forget, 24 is an election year, so there will be tremendous focus on the state of the economy when that election occurs.
So general consensus, no surprise that it's really hard to figure out where the world is going. And you and Connor touched a little bit on this, but how do you think about running a business in a period of such uncertainty, right? It's got to be different than when you run your business when things are kind of humming along. In one respect, we have no idea really where the economy is going. I also talk to clients who think we're already in a recession. Folks say we're not going to be in one. Some folks are predicting a 2-year deep downturn. That would sound pretty bad. Others are saying we're going to have a soft landing, et cetera, et cetera. We really don't have an understanding of what the new cost of capital is going to be. I think the industry and the world, for that matter, is pretty smart. No one's waiting for it to be as cheap as it was before the change here, but they're certainly hoping it's not as expensive as it stands currently, right, once the Fed finishes its moves. So how do you run an organization in that environment, and how do you think, and Ed, you touched on this, how do you think about growing, right, the balance between being offensive with your balance sheets and your capital at a time where maybe things look a little bit more attractive, but also harboring the capital needed to protect the value that you already have, in any particular order?
Sure, I'm happy to. I guess I have the benefit of being in retail my whole career, so I have a lot of war wounds to show that when the tide goes out and you're not in favor, you really just focus on what you can control. And in retail, we've been out of favor for what feels like over a decade. To see the fundamentals come back in your favor, it's nice to see sort of the opportunity set change, because for many years when you don't have a cost of capital advantage, you really batten down the hatches, you cut costs, you focus on what you can control, and you try and eke out organic growth. in a period of time where you don't have the luxury of using your currency, your share price, to go and expand and grow externally. So having that experience base puts you in a position to continue to focus on really motivating troops. I think that is really still a key. You've got to be, and again, cautiously optimistic is a term we use a lot, but in order to really outperform, you've got to have the best people. And there's a lot of really talented folks in this room, students and everyone that's looking at next careers. Some of the really unique opportunities you have here today is to mingle and mix with folks that all started somewhere. And I would encourage you to stick out your hand and say hello, because this is a really unique environment. And in environments like this where there is a lot of question marks of what happens next, usually that really creates significant opportunities in the workplace. I know it happened to me when I was in grad school for real estate, and all of a sudden I was working through grad school, and when we came out of grad school, it was the great financial crisis and there weren't any jobs. But since I was working, it was one of those unique situations where nobody was going into real estate, and created a massive opportunity to grow within the organization that I was in. And so the only reason I mention that is because there's so many students here today that whatever sector you're most passionate about, or whatever real estate part of the economy you're most interested in, this is a very unique environment, and definitely take advantage of it, because everyone here is out to help the next generation. It's sort of part and parcel of the opportunity that we've been given, is to pass it along to the next generation. So please make sure to take advantage of that today, because it's a very special place.
So we are, especially for the students, we're known as a net lease REIT, or a triple net lease REIT, which means we basically operate nothing. It's oversimplifying a little bit to say we just collect rent, but that's kind of all we do. And then we go buy new stuff, so we get more rent. And that actually relieves us of a certain burden of having to focus on the business and its fluctuations day by day, hour by hour. I used to be in businesses like ski resort management and hotel management. I'll tell you, those are kind of business model hell, capital intensive, labor intensive, weather dependent, otherwise what's not to like. I have died and gone to business model heaven, and you're all with me, I guess. And because of that, we can take a longer view. It's one of the reasons we so value doing business with American tribal nations. We do business with 4 American tribal nations: Seminole of Florida, Eastern Band of Cherokee from North Carolina, Cherokee Nation of Oklahoma, and Mashantucket Pequot of Connecticut. And what we really enjoy about doing business with them is they actually genuinely think in multi-generational terms, which actually aligns very well with our business model, because our weighted average lease term is 40-odd years. So we not only have the opportunity, we also have the responsibility on behalf of our owners, some of whom are in the room, to think about not just the cyclicality that's taking place right now, but what are the secular trends. And there's 2 very powerful secular trends right now that rise above all of this cyclicality quarter by quarter, and those are the aging of the baby boom, of which I am part, and especially for those who will have some money to spend, and unfortunately not all aging baby boomers will, is how are they going to spend their time in the next 10, 20 years in the pursuit of leisure, recreation, wellness, sociability, and all of those things, and how can we support those experiences. And then the other big secular trend for probably the next 10 to 20 years is millennial family formation. The greatest number of millennials were born in 1990. They're 32 and 33 right now. Family formation was somewhat delayed, but it's now taking place. Bank of America cited recently, I don't know where they got this research, but that the American intent to pursue pregnancy has never been higher, right? It's one of the reasons we're invested in Great Wolf Indoor Water Park Resorts with Blackstone, because of our conviction that there is this secular trend around millennial family formation that will have enormous impacts on leisure and entertainment, and also youth sports, which we want to invest in as well.
How about the topic of interest rates, right? Interest rates seem to have such an impact on our industry, and I think, frankly, every industry. If you ever needed a case study, there were a number of people who spent sleepless days over the weekend when SVB situation occurred, and you get up, Monday morning, and you expect an awful day in the market, and what happens is everybody perceives that the Fed will stop its raising, and in fact, interest rates starts to come down, the stock market goes up, right, on the heels of that news. I guess there could be a complete collapse of the financial banking system, but hey, interest rates are down, and the market goes up. So if you ever needed a crystallized view of the import that people see that an economy, how it affects the economy, there you go. So in your businesses, how are you managing the current environment? So there's a world of pain coming to every business model that exists when you have to refinance from X to Y, right? Because as we discussed, I don't think anyone's waiting for the financing market to go back to where it was. Do you sort of wait it out? Do you take a view? Do you using derivatives? How do you think about interest rate exposure and the remarking of your balance sheet?
Well, maybe I'll start and speak to the students, because I think one thing that's unique about our company on this panel is we have relatively short-term leases. So we're 12-month leases, and what that means, of course, is that we're more reactive to what goes on in the economy. So we'll move up and down, we'll capture upside, we'll realize downside as employment and other patterns change. So when I think about the balance sheet and interest rate management, we've got some debt coming due this year. We were super proactive about doing some forward-starting swaps, so we covered the interest rate risk. The other risk is just, can you get the money? And how does that feel? And we've all been around a while. In 2008, that was really tough. Fannie Mae and Freddie Mac, who are big lenders in the multifamily space, provide a certain amount of support to our space. They lend in good times and in bad, so that's kind of helpful. So I can have a little more assurance I can get the money. So you try and kind of be thoughtful about that. So I think being really aware of your balance sheet. There are certainly people who ran good businesses and ran bad balance sheets in real estate, and it's sort of a pass-fail test. If you end up on the wrong side of that, you can get really hurt. So we've been, I think, really focused on that refinancing. I think you talked at dinner, I think yesterday for a moment, you made a comment about how cap rates should be considerably higher given where interest rates are, or they have been in the past. And I just wonder if the counter to that isn't the huge amount of money sloshing around. Again, we spoke of one prominent PE firm who just closed on a $30 billion fund, and there's just a lot of money around. And I just wonder if the pressure to be invested in these good lines of business isn't going to offset what would have been the naturally higher. People tell me, okay, cap rate should always be 200 basis points higher than this or that. And I say to myself, yeah, that's true back then, but there's all this capital. It's always dangerous to say things have changed, but there are fundamental changes. I love Ed's comment about themes, and just to share the apartment theme is single family is really expensive, and people like to rent because of the flexibility, and they'll rent longer, and that millennial renter will stay with us longer. So our average renter is 32 years old. So the question I often get from investors, are you worried all the millennials are going to move out? And I say, to where? I mean, what home can they afford to put that down payment on, and how can they afford to make those payments, which are usually 30% to 25% higher than the rent they're paying us. So again, I love this idea of themes. I think that's important, and having insights. And I think to your question about the balance sheet, I think it's a pass-fail test. That's the first focus, because it keeps you from losing capital. I think it's the first thing on my list every year.
And I think what companies like Mark's are doing in terms of capitalizing on insight, you're making it harder for people to move because of your insights into how they want to live and the way you're amenitizing your buildings, yeah?
Yeah, I mean, we do try and meet the millennial renter who wants more space. So you might have come to New York originally from somewhere, and you're happy with a studio apartment. You're really just hanging your clothes. You're out there. Well, now you've got a partner, and you need a little more space. So we get more interested in 2 bedrooms and 3 bedrooms. We go to Sunbelt markets. We're buying a lot of suburban and developing a lot of suburban properties. Got a big property going up in Harrison, New York, which is definitely a suburban asset. So we're absolutely trying to follow that bouncing ball of demand.
So on the answer on interest rates, I would step back for a second and say, what's our philosophy? What's a company's philosophy on how it funds itself? So the first thing is, and we learned all this in the most recent bank disruption, you want to match your liabilities with your assets. It sounds kind of obvious, but that's what we try to do. So we have about $13 billion of debt, and 10 or 11 billion of it is fixed rate, 10-year unsecured bonds that we've issued into the market, and we're an investment grade issuer. we have some floating rate debt, which I'll come back to. So that's first. Then second, I guess I would say I've learned over the years to have confidence about what you know, but also to be confident about what you don't know. And what I definitely don't know how to do is predict interest rates. So what we try to do is ladder that debt portfolio evenly over a 10-year period of time, so that in any one year, we're not facing a huge amount of maturities. One, from an interest rate standpoint, and also from a liquidity standpoint. So generally, we've got this $10 billion debt book that is laddered out over 10 years, and there's $1 billion that comes up every year, and we basically take what the market gives us. So now coming to today, what does that mean? Well, right now, we absolutely have access to the unsecured market, but our spreads are wider than average. And so it's not an attractive market for us to issue. So we might do that, but we also have other options, fortunately, which I do think we have specific assets that we could mortgage and other sources of capital that we look at. The other move that you can also look at right now is your floating rate debt, of which we have about a little bit, about 10% of the portfolio. Could you swap that? And if you look at the 1 year SOFR swap rate, it's about flat, and I don't think we're, at least right now, prepared to take that bet. That flat is a good bet over the next year.
Right.
I think we all manage the balance sheet similarly. We try and go long. We were in a period of all-time low interest rates, and so we were able to access the 30-year bond market and push out maturities. Our weighted average maturity profile is over 10 years, so it's quite long for a REIT. We don't have any floating rate debt because we figured that would be a very tricky thing to try and refinance and distress. And the nice part is like when we manage our businesses, we're all, I think, investment grade credits, and so we have the opportunity in the unsecured bond market. And what we've been doing is unencumbering our assets. And so what you try and do is make sure you have liquidity optionality. And when you unencumber your assets, the one market in the great financial crisis that didn't close down was the mortgage market. And so our job has been really we're now over 95% unencumbered on the asset level, but you always have that card to play if things really, really get tough.
Yeah.
Hey, Mike, the thing I will just add is that if you're a REIT with substantial liquidity, which we happen to be, when interest rates go up, it's not a bad time to lend money against great real estate. We are not a mortgage REIT, just to be clear. But when we see an opportunity to support a partner who's either developing or owns great real estate, we will lend selectively. We'll keep it to a dull roar in terms of assets under management. But as an example, last year, a very, very powerful company, Koch Industries, or their real estate division, Koch Real Estate, K-O-C-H, not C-O-K-E, came to us and asked for help in financing the completion of the Fontainebleau Resort in Las Vegas. And as we publicly disclosed, we were able to come to an agreement where we're financing the completion of that at SOFR plus 700, so around 11%, to a phenomenal credit that has never been known to go bad on debt. So again, if you're a REIT with liquidity and you have confidence in what you're lending against, it's not a bad time to make money with your loan book.
So on the heels of the discussion of rates, maybe move to value, and all these topics are obviously interrelated. This is not unusual whenever we have a pause in the system, let's call it. We've had a bunch of them over the last decade or two. You always seem to have a standstill where assets don't trade, right? Absent a massive amount of distress, which we have not had during the financial crisis. And you have to go back to the days of the RTC before that to get to the point where things were forced. And so I think right now you have one of those moments where there is a complete lack of clarity, tell me if you agree or disagree, on value. Like, what is the new value proposition for almost every type of real estate? And that's based upon, again, not understanding where the long-term cost of debt capital is, and a little bit, as we discussed last night, we're talking about cap rates. It's just really hard to underwrite cash flows, EBITDA, NOI right now when you don't really know where the economy's going, right? And what's going to happen to those flows, and to slap a big multiple on those. So you don't have assets trading, which then, and by the way, I think most people have come to the conclusion that even if cap rates go up, That's not the end. What you really care about is value. So if cap rates go up because interest rates are higher, but due to inflation perhaps as well as just growth, your NOIs and your EBITDAs are also going up. You put those two together and you're going to come up with a value proposition. It's not a one-way stream just based on cap rates. So with all that as background and the complete lack of clarity as to what NAV really means, what I like to do is look, by the way, I love historical charts. When you look, for example, on the heels of the financial crisis, and I forget what publication it was, and there's a track of where cap rates are, and you see this huge spike during the financial crisis of where cap rates went. And the reason I find that to be a fallacy is nothing trades. If nothing's really trading, I don't know how you can assess where cap rates are. To me, that's a line on a piece of paper, not a historical look of where cap rates went, right? Because if people aren't selling, then it's not an arm's length trade. So with all that as background, the great word NAV, how, if at all, do you all use NAV when making business decisions? Whether that's issuing stock, growing acquiring assets, portfolios, or companies, is it something you think about and you focus on, or not? And how do you use it?
I can start, I guess. I mean, apartments are useful because they're a commodity. There isn't a GM building of apartments. They're just apartment buildings. So they can be more, I think, consistently underwritten. And cap rate's certainly helpful, but to Mike's point, it's really hard to guess income. It's really hard to guess your exit cap rate 10 years from now, which is usually the period of time we're doing our underwriting. But what we do know right now is replacement cost. We know what it takes to build a building like the one we want to acquire. As I just said a moment ago, they're very much similar. They're of similar type. So if we can acquire a building at a 10 to 15% discount to the replication value of that building, that feels good to us. It's both a moat because a developer would have a hard time building into that market. There's not an automatic profit, and there's a little safety margin for us. So I also like to look at the end of the deal and say, 10 years from now, what are we guessing our exit cap rate implies as to the value per unit? So I remember we bought our first thing in New York. We were buying things at $1,100 a foot. We had never done anything near that 10 years from now. And that at least worked out very well. So those per unit, per pound numbers, which are equivalent to an NAV for a big company, but I'm talking on a per asset basis, are super helpful to us. And NAV for us, when we're trading at a big discount like we are now, to me is a signal not to grow by raising equity for sure. So what our company's done for the last couple of years is really just trade. Sell stuff in California, buy things in Texas. That's been the equation for us. The thing you got to watch out for, and that's what happened in late 21, when we didn't buy very much at all, was there was really huge premiums. So people were selling assets for 3.25 to 3.5 cap rates at a 20 to 30% premium to what it costs to build that asset. And we just couldn't find a lot of cases in our 30-year history, and we're not quite as old as Kimco, but close, that paying 30% above what it costs to build a building led to a good, profitable outcome. So we just stopped. So that's what NAV means to me on the company. But on the asset basis, we think of replacement cost a lot.
And maybe for everybody, but on the heels of the comment you just made, most people would think that they do trade at big discounts. NAV, how are you calculating that NAV, right? Because as you said, we just went through a period of time of people paying 3 cap rates and stepping over each other to buy. Are you looking at a longer term view of where apartments are traded or shopping centers or office is the most complicated, I presume, right now, but how do you think about it?
I mean, usually we have the advantage of it being a super liquid market and the lot's traded.
Right.
So we'll literally underwrite all 300 of our properties, present that to the board in March and go, hey, this is our NAV. And on that basis, we'll make decisions about equity issuance and anything else that's important through the year. This year, we've deferred on that conversation. I have no comps. I just think everything's worth blank % less. I mean, it's not a very, right now I'm a little stuck to your point.
Yep.
And when you're a little stuck, you pay attention to the balance sheet, run your operations. Maybe you swap assets a little to balance the portfolio, but it's hard when, Ed's got a cost of capital advantage that I just don't have at the moment.
You could take some of his capital when he's not looking.
NAV, net asset value, may be, I'm sure it is a valuable metric, a valuable check against value in mature categories. That's not what we happen to be. Even still now, we're a little over 5 years old. Dean, I apologize for the profanity in advance, but for the students in the room, we were known among many Wall Street bankers who had a certain amount of skepticism as to whether we could ever succeed as Project Shitco. when we were in our very, very early stages. And that's because...
And you took that as a negative.
I thought, well, we're going to show you. And I promise that's the last profanity. Last night I wasn't so good. But anyway, net asset value is a construct that doesn't necessarily work very well in a category that is still in the process of institutionalizing. And what institutionalizing means is that institutional capital is in the early stages of beginning to understand the category. And I think you can take it as axiomatic that a category will not be fully valued until it is fully understood, okay? And what we have been embarked on in the last 5 years at Vici was telling the story of this real estate so that investors could begin to understand it better, okay? Our original shareholder base was 100% distressed debt hedge funds, the most unnatural group of equity owners you can have in a REIT by any measure. But it was all a function of us having spun out of the Caesars bankruptcy. But we knew we had the opportunity to tell a great story about how good this real estate is. And over these last 5 years, we've been able to gain a lot of sponsorship from institutional capital as that understanding has grown. But I would continue to argue, based on our multiple, that we are still not fully valued. We're about 5 turns behind the median AFFO multiple for S&P 500 REITs, despite the fact we had the best total return of any S&P 500 REIT last year, the only one with positive total return of 13%. We've got consensus earnings growth of 10% this year, and yet we still trade at a discount to many of those we consider to be peers. So when analysts, some of the sell-side analysts talk about, oh, Vici appears to be fully valued because it's in line, its current value is in line with the multiples it's traded at over its history, it's like, dude, if that's the approach you're going to take, you are going to get left behind in every freaking cap rate compression story that ever takes place. If you don't work hard enough to understand the potential of revaluation for this real estate, NAV, as you understand it, is going to anchor you to basically lost opportunity.
Anything, you guys, any differences in the way you approach it?
Well, I think I just step back for a second and talk a little bit about the office sector, because I think it's we face our own unique issues at the moment. And then I'll come back to the NAV and valuation gap question. So I do, as probably many of you know, the office sector is very out of favor at the moment. And I honestly believe it's misunderstood in many ways. And what do I mean by that? A couple of things. One, I think there's a concern that what's going on in office today is a secular issue, which is work from home, as opposed to what I really think it is more of, which is a cyclical issue that I described earlier, which is businesses are taking less space. Obviously, cycles reverse themselves, secular changes don't. And again, I'm not suggesting work from home is not an issue, it is. But if I look around the world, and frankly around the United States, except for the West Coast, most businesses are back in the office at least several days a week and growing. So I think that's becoming less of an issue. And then I look at our own company's performance. Last year, we leased kind of a normal year of space for us. The economy was strong, less people were in the office. It's slowing down this year because the economy's weaker, even though a lot more people are in the office. So anyway, that's one. And then second, the other thing is a flight to quality, and I think the best way to summarize that is our clients are differentiating the buildings that they want to lease much more than the capital markets are differentiating which buildings they want to finance or buy. And to me, that's a total mismatch. So what does this mean? Mike, as you said, there haven't been many trades, so it's hard to see where value is. The public REITs in office are down something like 50% plus or minus from peak. The NCREIF index, I think, this recently is off 6%. And, you know, what's the right answer? I don't know. I think it's somewhere in the middle, but we don't really know what the answer is. So thinking about NAV going forward for us, you know, I don't think the market focuses on NAV. Our shareholders, that's not an argument that I would make to a shareholder about why to own our company. I would argue that the reason you should own our company is because the quality of our assets are unmatched and that we actually are going to grow the business. So how do we focus on growth? Well, frankly, the first one is we should just lease our portfolio. You know, we're 89% leased. We were 92 or 3 before the pandemic. It's all sitting there. We already invested the capital. Let's lease the portfolio. And also, by doing that, we would disprove all the skeptics about work from home. So I think that's kind of a simple, stupid answer, but that's really important. And then second, we're a talent, we have a skill as a development firm, and we actually did just launch a couple $2 billion of 100% leased lab new developments and conversions in Cambridge at very significant yields in the fourth and first quarter of this year. So we are investing capital. So we don't, now in terms of NAV, we certainly think about that when we invest money. Because when we do the analysis of a building or a development or an acquisition, we're absolutely looking at typical private market valuation metrics. But we don't talk about NAV as it relates to the opportunity with buying the shares of the company.
Yep.
Very similar analysis. I mean, when you look at net asset.
I see you went full Phil Donahue there. They gave you the mic. Yeah.
Here we go.
Yeah.
When we
When
look at net asset value, I think we do it from a bottoms-up approach, best guess on the cap rate, and try and figure out where things are trading in certain markets relative to our portfolio. The nice part about the shopping center sector is usually the shopping center is bite-sized relative to some of these larger products that we're sitting around here. So $15 to $25 million is the typical purchase price of a shopping center. So it's a very liquid market, and 80% of that market is still owned in the private hands. So typically there's a lot of transactions that you can get very comfortable with where the market is. We are in a bit of a pause here where there's a big bid-ask spread between buyers and sellers. But I do feel like that's going to change soon just because the amount of conversations I've been having with more institutional capital being constructive on our space. And typically when that happens and you see capital formation starting to flow to your sector, you're going to start to see transactions occur. And that's what I think is next up for the portfolio.
Yep. No, it's all well said. I mean, we always do, right? There's a pause where nothing trades, and it makes sense. We saw this during the financial every pause in the world that we've seen, because usually when you lose, half of your value or half of your net worth, the first human instinct isn't to bet the other half. It's ready to harbor your assets, and then eventually things just start to trade. It's not great for our business either, as you guys know, because when things don't, there's just no connection between buyers and sellers, again, without distress. The sellers obviously don't need to sell at inflated rates today, and every buyer that we speak to has a conundrum of their own, which is if I put the money to work too early, I'm going to feel foolish and perhaps look foolish if we go into a period of distress, because I know there might not be a lot of capital coming behind that. And if I wait for the all clear sign, as we've seen that movie before, it's going to be too late, right? And the world goes rampant back up. So that is, I think we all eagerly, the real question is when, right? And we have a hard time figuring it out. Let me ask one more question, and we'll leave time for a question or two from the audience. A question I'm ill-equipped to ask because I'm not very good off the speed, just ask my kids with regard to technology, but an early view, an early look, an early guess on AI and what that might mean for the industry and how you might be able to use it in your business. Just quick guess across the board here.
I'll start with that. I spent last week in California, and I take the Bay Area in particular is AI crazy. I mean, every conversation was about AI. There are a couple of companies, startups, that are out in the market with significant lease requirements right now in the Bay Area for AI startups. So, I think to me the biggest impact, and I know it's not exactly the nature of your question, but it's a potential demand driver for our product.
Yep. I think it's going to be massive. I really do. I mean, we talked about it last night. It's, I think, going to fundamentally change a lot of the value add product that workers do today. I try not to think on the defensive side of how many jobs it'll eliminate. I try and think on the offensive side of if you can produce, say for a lease, for example, if it takes a typical lawyer 2 days to produce a lease, and you can have artificial intelligence produce it in seconds or minutes, it's still going to need 20%. It's going to get you 80% of the way there, but you're going to need that 20% to fine-tune it and make sure it's what you want it to reflect. I just think of the output that could create and the opportunities that it could enhance in terms of worker productivity, and I think it's just massive, and you can go from legal to architecture to you name it. It's really going to, I think, impact every single industry. And so we're trying to map ways that low-hanging fruit, we can use it immediately to enhance production with not necessarily changing the workforce, but just continuing to try and produce more from what we have.
You know, our business is dependent upon our operators coming up with compelling reasons for people to leave their houses and come out and have shared experiences. And when I think about what AI could mean for a brand new asset being developed on our land at the Venetian, that being the MSG Sphere. The MSG Sphere, when it opens in September with U2, will be a game-changing experiential asset. But what AI could mean over the lifetime of the MSG Sphere in terms of the experiences that get created, I can't even begin to fathom.
Yeah.
I don't have any cool spheres to speak of. That's pretty cool. We talked about it a little bit at dinner.
Glad you're not paying for it.
Yeah, I'm sure it's a little big nut. What we're using AI for, and this is a junior AI use case, was discussed at dinner by Ben Shaw of Avalon Bay. We have some technology we developed with them a few years ago that answers 80 to 90% of our inquiries. So if you call in, you can certainly call to our call center as a resident or a prospect. You want to talk to us, that's fine. But if you are on hold, you want to switch over, you want an email, you want to chat, we have the ability to go back and forth. So you can ask questions about whether a property allows pets, what type of pet rules, where the nearest grocery store is. It is super agile. Our residents love it. It actually has a higher closing ratio than our living, breathing, physical leasing agents do. So the ability to expand that, and it just allows our customer service people to do the higher end tasks. So there certainly has been some job destruction, to Connor's point. There are jobs that disappeared in our company, but at the top end, the hiring in the IT roles is certainly higher. And I think our customer experience is better because, again, you can talk to a person if you want. If you just got a quick question about something, certainly the system can answer that for you, and we've had good reaction and response from that. And I think we'll scale that out.
You notice Ben hasn't heckled you yet?
Heck, it's coming. He's worried. He's got a panel next.
Oh.
Yeah.
Okay.
Headface, can we do a question? We have time for one question. If there's a burning question, one question. Yes, sir.
I'm interested in what you think of the casino ideas that are being floated in New York City, the job creation that possibly could
Yeah, so it's going to make a great season for Billions, which needs a great season. It kind of jumped the shark. But seriously, it's. I will tell you that the way, for instance, the New York Times has been covering gaming, I think is quite frustrating to me. In that I don't think they're giving full measure to the positive economic impact that gaming can have. In many of the states where our operators operate, in many of the states where we own buildings, gaming is the #1 funding source for public education. And what is likely to be the economic productivity of a New York City asset or a Long Island asset if LVS, Las Vegas Sands, was to win the bid, will be enormous. It will create a lot of jobs. It'll create good, higher paying jobs, and will create a tremendous amount of economic activity that will greatly benefit the surrounding ecosystem. I really am baffled, frankly, by the Times Square people who are going, oh gosh, we don't want a casino here, we don't want a casino here. You know, you ought to go actually spend some time in the Las Vegas Strip and see what happens when an ecosystem gets built around gaming. The #1 CVS and the #1 Walgreens in America are on the Las Vegas Strip, okay? Everybody kind of benefits when you create these giant economic magnets that can attract visitors and create economic activity.
Okay, we're out of time. Thank you all.